Well, let's welcome now on the show our very first guest, Raghvendra Nath, the MD of Ladderup Wealth Management, to talk about what your mutual fund investment strategy should be right now. Mr. Nath, thank you so much for joining us today on ET Now. Well, record highs for the Nifty, the Sensex, and what's more, the small and the mid-cap indices have also been rallying even more and faster than the large caps. We have seen mutual funds return 50 to 120% in the last 1 year. Mr. Nath, as we sit at record high levels, what should a mutual fund investor strategy be right now, assuming that he or she does not really have any big expenses to pay for which they were investing in mutual funds?
Yeah, Mubina, I think this question is, clouding everybody's mind these days. And as you rightly pointed out, last year has been one of the best years that indices have seen, the equity markets have seen. Obviously, the preceding year, we also saw a crash in the month of March. But the way the markets have rallied from the lows of June and July has been unprecedented. And I think these are one of the first few, very, very few instances that I have seen in my last 25, 27 years of working career, where markets have seen such a strong recovery, and it's been a broad-based rally. As you rightly said, large cap, mid cap, small caps, everything has done well. The point is that, and if you were to just look back at history, equity markets basically have a habit of generating a large amount of return in a very short period of time, only once in a while, and other time periods, markets are either kind of sideways or they are in negative territory. Okay, so when you look at a period like this, which has like last 1 year period, one needs to look at it from a little longish term in terms of how much return has he generated in the last 3 years or 5 years or 7 years. And in any ways, when you are investing, especially for those mutual fund investors, if you are booking profits or something like that at this juncture because you are thinking that the markets are overheated, where are you going to invest? Are you going to invest that money back into fixed income or do something else? And as you said in the beginning of the show, that if it was asset rebalancing or goals, that's different. But if you are just doing this exercise only for the sake of booking profits, my suggestion will be don't do that, because you are in for the long haul. Equity markets, when you're investing, you are not investing for 30, 40, 50% returns. You are investing for multiplying your wealth 10, 15, 20 times. And that's what has happened in the last 20 years. On an average, a mutual fund investor in the last 20 years has multiplied his wealth 13 to 15 times. And that's an average. Some funds have done even higher. So when you're talking about that kind of multiplication over long term, why kind of worry for a short-term blip which has happened, whether it's 20% or 50%? That's the thing that we need to ask ourselves.
Well put. When you invest in equity mutual funds, don't be satisfied with just that 40, 50, 60% return, because firstly, yes, MFs have a tendency of returning a large return in a short period of time, and then they largely move sideways for the balance time. You have to look at your portfolio from a more longer term. You're extremely lucky if you invested last year, maybe in April, May or June. But if your goals are nowhere close, even if you, let's say, book your profits and, redeem your mutual funds, ask yourself, where will you invest? Today, a fixed deposit gives barely 5 to 6%, and that too, from a reputed bank, a large bank, which, of course, is among the more safer ones comparatively. So I think that's a question that as well you must ask yourself. Now, let's talk about, rebalancing, the rebalancing bit that you as well spoke about in your previous answer. Now, equity investors have done, equity MFs have done very well, but debt funds, at least in 2021, have actually, many of them have been in the negative as well. Liquid funds today, so far this year, have barely given 1-2%. Similarly, long duration funds, all of them have been largely flattish or they've given negative returns. So would rebalancing then, if I had to rebalance my portfolio right now, I'll obviously see that, okay, the equity value of my portfolio has gone much higher while the debt value has reduced. So would rebalancing then involve more buying debt funds?
Mupina, I think when you're talking, when we talk about rebalancing, we are basically trying and adjusting the risk of the portfolio. So let's say there is a moderate risk investor who invested 50% in equity and fixed 50% in fixed income. And in the last 1 year, because the markets have given 60-70% return, now his 50% is basically has become 75% or 80%. Now, rather than being a moderate risk, he is actually an aggressive investor. And so, obviously, he should take an action at this stage when the markets are also doing well and readjust the risk of his portfolio and bring it back to moderate risk if he so desires. So when that is the objective, of course, he will have to basically book profits out of equities and he'll have to invest that money into fixed income. Yes, you are right that fixed income has not produced too much return in the last 1 year or so, because and the reason for that has been, let's say, volatile interest rates, as well as yields have fallen down significantly. But that's the new reality that you need to adjust for, because fixed income investing is basically to keep your portfolio at pace with inflation, nothing more, nothing less. Okay, so if inflation is 6%, your fixed income portfolio will generate somewhere around 5-6% return. If it's the inflation is 10%, then your fixed income portfolio will generate 9 to 10%. But generally, fixed income will keep pace with inflation. So since inflation is low, interest rates are low, you need to adjust to the new realities and basically move that money to fixed income because your risk in the portfolio has gone up substantially. And that should be the purpose of rebalancing, and if the rebalancing is only for some other purpose, I would say that hold on to your portfolios.
Okay, so, the intent behind rebalancing your portfolio is simply to account and adjust for any changes in the riskiness that your portfolio carries. Obviously, equities do inherently they're a little more risky compared to the other asset classes. So with this rally, if the value of your equities has increased very drastically, then you could be essentially carrying more risk as well in your portfolio. So you could consider then booking some profits in equity MFs and putting it in fixed income if you desire to bring down the overall risk in your portfolio. That's the definition of rebalancing. That's the intent behind rebalancing, and this is the reason why you should consider even booking some profits in your equity mutual funds. Mr. Nath, question that a lot of individuals would like to ask themselves is that
I am seeing the broader market do. How do you judge that? And is that even the right approach to look at it?
Properly?
Mr. Nath, I was actually asking about when individuals compare their own mutual funds with the benchmarks and they perhaps sometimes see underperformance. What should they do then?
And in fact, this is happening very regularly for the last few years, and where people have invested into actively managed mutual funds and they find that the benchmark has actually done better. And so, all that extra fees that they are paying is basically doing them no good. And the point is very valid that when we are investing into actively managed mutual funds and not passive funds like index funds, our expectation is that these funds should basically outperform the benchmarks. Okay. And my suggestion will be that clients basically, if there's an underperformance, clients should see whether it's a category issue or it's a fund specific issue. Many times, like I remember 2018-19, that financial year, almost every large cap fund underperformed the Nifty. There were only one or two large cap funds which outperformed. Barring that, everybody else had underperformed. And the reason for that was because Nifty, only 6 or 8 stocks had basically given positive returns. Everything else was negative. And the stocks which had given positive returns, while the funds had those same stocks, but in much lesser proportion. So Reliance was there in most portfolios, but it was not 10 or 12%. It was only 2 or 3%. And therefore, while those stocks did well, the proportion was much lesser, and therefore funds ended up underperforming benchmark in that year as a category as a whole. So if that is the issue, I think people should just stick on, because these kind of extreme situations where only a segment of the market or a section of the market is moving and everything else is not, is only for a very short period of time. Otherwise, markets basically tend to kind of take notice, and if there's an underperformance or undervaluation in some other sectors, those sectors come back eventually. So you should look at your underperformance versus, let's say, or performance versus benchmark, first of all, for a little longer periods than just 6 months and 1 year. And the second thing is you should compare whether it's the fund specific problem or a category problem. Yes, if it's a fund specific problem and you have been around in that fund for 3-4 years and it still underperforms, it's time to basically replace that fund with somebody who's actually doing his job properly.
Okay. Let's talk then about, according to you, Mr. Nath, if someone has to now look at, whether it's rebalancing their portfolio or it is because, their goals are approaching and now they want to sort of, crack into the savings which they've been putting into mutual funds. They basically need the money. With markets being at record highs, it's a good time to then do that. So, Mr. Nath, according to you, what's the most efficient way of slowly starting to book profits in equity MFs? Should you do it in one lump sum? Should you do it systematically? Should you do it as an, as a way that you start transferring bit by bit to a debt fund or a savings account? What do you recommend?
So when you are doing, let's say, profit booking from equities, okay, the whole point is that you are finding markets at a very attractive level, and that's the reason why you want to book profits. So then you should not get further greedy and further ambitious and try and time the market that, okay, market, if it ends up higher, then I can basically, let me do it only in small bits. So if, let's say, you have a goal, let's say son's education, which is coming up next year, and you want to basically, you had put some money in equities for that purpose, the better thing to do is, markets are good right now. Maybe markets can go up another 10% or 15%, but, just basically hold on to that extra, or maybe sacrifice that extra return, whatever is there on the table, take it and put that money into something which is more safe and secure and steady, which is like fixed income, in all probability. Or if you're doing rebalancing, again, you should do it when the markets are in good condition. We may be thinking that markets will become better after 1 year. What if something goes wrong and the markets have fallen back to wherever they were, or let's say corrected 15-20%. So I think divesting slowly in equity market is not a great idea. I think we should just do it in one shot, or maybe in 2-3 months. Okay, but that's about it. So when you see a foreseeable future, okay, markets are looking in good conditions, so rather than booking everything in one go, maybe you can book it in 3-4 parts. But that's about it. A elongated period of withdrawal from equities for the purpose of meeting a goal or for a purpose of rebalancing is not a good idea.
All right, understood. So there you have it. That's all you need to know when it comes to what your MF investing strategy should be amidst this massive rally that we've witnessed in, the equity markets. How can you as well efficiently take advantage of this, and rebalance your portfolio or start planning to meet your goals as well. Okay, well, we've got a couple of questions and queries then from our viewers. Let's take them on one by one. Remember, folks, you can connect with us. Our email address is themoneyshow@etnow.tv. Our first question is from Mr. PV. PV says, should one exit equity mutual funds when returns surpass 25%? I know you partly answered this question during our Q&A, Mr. Nath, but still, for the benefit of PV, he's put a more modest sum of 25%, I suppose, and he's not mentioned the time period either, because that too plays a role. But yeah, Mr. Nath, your view?
Mubina, and this is something that we encounter very, very frequently, and people think mutual funds are like stocks. and a stock price goes up, they book profit, and then they wait for the stock price to come down and they reinvest, and so basically even that's also basically that's not investing, that's trading, first of all. Okay, so stock trading and mutual fund investing are completely different. They are like chalk and cheese. When you're investing in mutual funds, you are basically creating for wealth. You are aiming towards wealth creation, and wealth creation can only happen over a very long period of time. It can't happen in 1 to 5 or 10 years. Okay, so equity market investing, when you are doing through mutual funds, you should just invest that portion of your capital which you can put aside for a very long period of time. It's like buying a flat. If you were to buy a flat and let's say that flat went up by 50% in value, would you sell that flat? Or if you bought a plot of land, if it went up by 50%, will you sell the plot of land? No, because your mindset is that when I have bought that real estate property, I have a long term in mind. Maybe that may continue for next 10, 15, 20 years, or maybe I'll pass it on to my next generation, my children, and give them as a gift. Equity, if you were to look at with the same lens of long term, that's when you will max benefit out of it. And as I mentioned initially in the show, that if you invested 20 years back in a mutual fund, average return has been 15 times, and which is a lot of money. And that's in a short period of 20 years. 20 years is not a very long period of time. And so if you were to just extend that for even longer, the kind of returns that you can generate from equities can beat every other asset class. So we should stop looking at this, thing of booking profit, because every time you have that question, you should ask, book profit to invest where? And I think because you will never be able to give a good answer, cogent answer for that, you will not book profits. And, so unless you are basically shifting from one fund to another, a fund which was underperforming and you want to go to something which is performing better, that's a different thing. But just booking profit because you earned a little bit of return from equity is not a good way of looking at it.
Okay, so that's the recommendation coming in for Mr. PV and for our viewers as well. All right, well, we have another question this time around on fixed income funds that we have coming in from Subramaniam P. He says, due to the recent RBI rules, which of the following debt funds should one exit? I've invested in them since the last 1 year, and what are the alternatives for them? So there's Nippon Floating Rate Fund, Axis Banking and PSU, Kotak Dynamic, IDFC Short Term, and AB Sun Life Corporate Bond. Okay, there have been a couple of RBI rules actually in these last few months that we have seen for debt funds. But yeah, overall, what do you think of all of these funds? They are in very different categories, of course, ranging from floating rate to corporate to short term. What's your view on all of these funds that he's mentioned?
Yeah, so first of all, basically, when you're looking at debt funds, you are looking, as an alternate to, let's say, a fixed deposit or a bond which you can buy from the marketplace or a post office account. And mutual funds are fantastic alternates. The only problem with mutual funds is, from a retail investor's perspective, is that they are marked to the market. Okay, so if the bond prices go up, they immediately get reflected in the bond prices, and that's done because the new investors should not basically suffer or benefit from the old investments, and so everybody should remain neutral at all points in time. So when you are looking at investing in fixed income funds, the reality is that interest rates over the last 2 years, RBI kept on reducing interest rates because of the economic scenario, and interest rates have now reached a very level where they are stable. The RBI is not reducing interest rates further or giving indication for reducing further interest rates, but RBI still maintains a benign stance in the money markets, which basically means that RBI wants to have sufficient liquidity, so all the banks should be surplus with money, and RBI wants to keep interest rates at present levels and wants to support growth. And is not so much worried about inflation, which is in any case creeping up a little. But the focus is now on getting the growth back in the economy. And so in all probability, this stance may continue for another 1.5 years, maybe 2 years. Okay. And so these funds during this period of time will definitely generate lesser return than what you had expected. But when the interest rates go back, okay, the same funds can basically generate higher returns also. So my suggestion to you is that if you had invested in these funds as an alternate to FD or whatever, you should just stay invested, because these funds are all very, very high quality fund. Everything that you have mentioned has AAA, portfolios, so very high quality. If you want a little higher return, I would suggest basically look at some credit risk funds, like for instance, ICICI credit risk or HDFC credit risk or IDFC credit risk. These funds have SBI credit risk. These have very clean portfolios. And so while their name is credit risk, the fund quality is pretty superior. Most of the money is invested either in AA rated assets or AAA rated assets. And therefore, investing in credit risk may be a good idea. So other than that, I think you should just stay invested in wherever you are.
Okay, so that's the recommendation coming in, and given the fact that it covers a wide spectrum and variety as well of debt fund categories, I'm sure it's been useful for a lot of our viewers. And with that, Mr. Nath, we are out of time, so we will wrap it up on this segment. Once again, thank you so much for joining us today on The Money Show.